estimated that 76% of all homeowners in the U.S. have an interest rate of 5% or less on their home mortgage. 57% have a rate lower than 4%, and almost a quarter of all mortgages are sitting at 3% or lower. These unprecedented low rates that homeowners have secured has led to a phenomenon known as the locked-in effect. It refers to how homeowners feel as they consider the option of selling a home with a ridiculously low rate in order to buy a home that is better suited for their current housing needs at almost double their rate. Needless to say, homeowners suffering from these golden handcuffs are having to make the tough decision of staying in their homes and making do with their current housing situation, or selling the home and increasing their monthly payment, sometimes significantly. But what if I told you there is a good number of these homeowners that are opting to have their cake and eat it too? It is what we in the industry call becoming an accidental landlord. Today, we will cover what you should consider before jumping in and what numbers to look at to see if becoming an accidental landlord could be a good option for you. Hi friends, welcome back to the channel. My name is Sylvia and I am your investor-friendly realtor in the Boise metro area of Idaho. As a realtor and investor of over 20 years, I am a firm believer of real estate as a means to grow your net worth and build generational wealth. And I'm not talking about just owning your own home, but rather carefully evaluating what investing in real estate actually entails. Most people are deliberate in wanting to invest in real estate, and some lucky ones have found themselves an accidental landlord, as we will cover today. If you find yourself to be one of the lucky few who can get into real estate investing in this way and need some guidance, our team would be happy to help in exploring your options for getting into the real estate investing game. First, let's define exactly who are becoming these accidental landlords. As the name implies, most of these people did not follow the traditional method for getting into real estate investment. Rather, these accidental landlords have found themselves resorting to renting out a property they already own and instead using it as leverage to buy their next home. Why, do you ask? Well, quite frankly, the higher cost of debt is significant. Let's look at an example. Consider selling your current home with a loan balance of $250,000 at a 3% rate and making $200,000 after it's all said and done. You plop it all down on down payment and closing costs on a $500,000 house, leaving you with a loan balance of approximately $300,000 at a 6%. In this case, you have effectively increased your monthly payment from $1,054 to $1,799 for only $50,000 more of debt. Needless to say, most sellers are finding that the advantage of bringing a significant down payment, in this case 40%, doesn't justify the cost of additional debt they would incur if they sold the current home to buy a new one. In this case, many sellers simply choose to stay put and make do with their current home. Maybe they use the equity to add the extra bedroom they need. Or perhaps they remodel the old kitchen, making it more usable. For others, this isn't an option. What happens if you have to move? Some say that necessity is the mother of all invention. This brings me to our accidental landlords. These homeowners take advantage of the low payment and high equity of their current home and use it to propel themselves into the role of real estate investors, where they can benefit from rental income and tax benefits in the present and generational wealth in the future. In essence, they forego the larger down payment, keep the current home as a rental, and forge their path to real estate investing, all while taking advantage of the lower down payment, lower fees, and lower interest rates they will get when they purchase their next home as an owner-occupant versus investor. Consider this: as an investor, I will need at least 20% down payment. I will be offered an interest rate often 1 to 2% higher than owner-occupants, and will probably pay 2 to 3 points on my loan and fees. Chances are that when I bought my current home, I put anywhere from 3.5% to 5% down. I secured a lower interest rate and wasn't subject to the higher fees lenders charge investors. Now, I'm not saying that this will work for everyone, and making the determination requires some serious consideration. Before we crunch numbers, let's look at what you should consider before going down the accidental landlord path. First, do you even want to own rentals? The fact of the matter is that owning investment property will introduce added responsibility and liability into your life. And while they can be managed by hiring a good property manager, getting proper insurance coverage, and even employing measures such as LLCs or trusts, the buck stops with you in every case. Are you willing to educate yourself on the basics of fair housing laws, local landlord-tenant laws, property management, insurance, and liability protection? Second, being a smart investor means having a financial plan with an appropriate exit strategy. If you sell your home right now, you have the advantage of a capital gains exemption of up to $250,000 if you're single and $500,000 if you're married. If you rent the property for 3 years and then sell, that exemption goes away, subjecting you to capital gains tax. Smart investors know how to take advantage of plans like 1031 exchange or step-up basis to avoid these taxes. Or, at the very least, they would know to hire and interview the right team to advise them on how to exit or grow their investment. Either way, you should weigh your options carefully. Let's say you are more than willing to use your home as an advantage to jump into real estate investing. You have thought about the aforementioned considerations and have made the determination that you are willing to learn what it takes to be successful in this new venture. Where do you start? Well, great investments always start with the numbers. First and foremost, you want to determine if your property would have cash flow. Having cash flow means that after all the expenses are paid at the end of the month, you have some money left over from the rents paid by your tenant. To determine your cash flow, you need to account for all the income, in this case your rent, and all the expenses associated with the house. In terms of what rent you can count on, you should analyze local rents in your area similar to your home. Try Zillow, HotPads, and other local resources for this information. Or, even better, contact a few property managers and pick their brain as to what their expertise says you can rent your home for. When it comes to expenses, as the current occupant, you have the advantage over other investors in that you have intimate knowledge about everything that goes into keeping your home properly maintained. Lawn service, pest control, irrigation, HOAs, sprinkler blowouts, snow removal, and utility bills are just some of the expenses you want to account for. And if you will be hiring a property manager, then you want to include their fees as well. Now, you also want to account for expenses that might not happen every month, like repairs and maintenance, vacancy, and other major expenses that we call capital expenditures, or CapEx for short. Many new investors miss accounting for these expenses and find themselves in trouble down the line when they have unexpected problems in the home, or worse, no income coming in at all. Vacancy refers to how long your property might stay vacant and not earning you any money. When you rent your place out, the goal is to get a long-term tenant in place. However, life happens and you might find yourself with a tenant who decides to break the lease after just a few months. In order to be prepared for such an event, you will expense a portion of the rent monthly, which will sit in your account until you need it. Vacancy is expressed in a rate percentage. Your chat with the property manager should include a conversation on what the local vacancy rate is. If the vacancy rate in your area is 5%, for example, you simply multiply that 5% with your rent to get the amount that you should enter as your monthly expense in your calculation. Since vacancy rates vary, be sure to get the most accurate number you can find. Repairs and CapEx are also rates. Again, you have the advantage here. You are the best person to know what repairs and other CapEx are coming down the pike. If your fixtures and appliances are old, they might need repair or even replacing soon. And a 20-year-old roof is definitely something you would want to start saving up for. Repairs and capital expenditures can vary from 5% to 10%. If your honey-do list was a mile long, you might want to err on the higher side. Once you have all your income and expenses noted, you can determine if you will have any cash flow coming in. If you do, congratulations. But hold on, you do have more numbers to crunch. Now, if you are upside down by a reasonable amount, you will need to do some more math to determine if it is in your personal budget to cover the difference. In general terms, I do not recommend buying a property that does not cash flow. However, in this case, you already own the property. Depending on how much you are in the negative, you might be able to work the numbers to where you are comfortable if you have extra reserves or sufficient income from a job to cover the difference. This will require looking at your own finances much closer. Only you and your appropriate financial advisors can make this determination. Having cash flow is quite important. However, since investing in real estate always carries some risk, it is important that you also have some money saved in case things don't go according to plan. And in many cases, the bank will want to see some reserves before they approve you for your next loan anyway. Having reserves simply refers to 3 to 6 months of all expenses put into an account that is set aside for use on this property. As a new inexperienced investor, I would recommend the 6 months if you can float it. Think of it like an emergency fund for that property. If the HVAC goes out in the first month, your reserves would handle the cost of buying a new one. If your tenant up and leaves halfway through their lease, your reserves would be able to take care of all the expenses until you secured a new tenant. Keep in mind that your reserves should include even expenses that you pass on to your tenant, like utilities and lawn care. If the property is vacant, you will be paying these bills in the meantime. You also want to include what we call turnover costs, which are incurred in securing a new tenant. Things like cleaning the house for the next tenant, touch-up or minor repairs that need to be done, and also administrative costs like advertising or your time or a property manager's time driving to showings, screening new tenants, and signing a new lease. I want to point out the importance of keeping your reserves account intact even after you buy your new home. Best practice would be to keep this money in a separate bank account, earmarked for your rental. If you do use some of your reserves, you can replenish it with the money you collect monthly for vacancy, repairs and expenses, and CapEx. And of course, any extra cash flow that doesn't get used. Remember, unless you actually have a vacancy or repair, that money collected and accounted for as an expense stays in your bank account. If you have a serious expense one month and have to dip into that reserves account, you can build it back up as you continue to collect rent and account for those 3 expenses. The final set of numbers that you will need to look at will be the ones required by your lender to get you approved for your new loan. Most lenders are looking at your credit score, your income, and your debt to determine whether they will lend to you or not. Renting out your current home will change both your income and your debt. Most lenders will allow you to use up to 75% of the rental income you collect as additional income in your debt to income ratio, DTI. Typically, your lender will want to see a signed lease agreement with your future tenant before funding your loan. And they might even run a rental analysis to determine the appropriate rent you would be collecting. Check with your lender to see what they would require specifically. Either way, using the 75% is toward your advantage, especially when your property will cash flow. On the flip side, the debt on your current home will also be calculated into your DTI. If there is anywhere where you might run into trouble with your qualification, it will be here for 2 reasons. First, traditional financing, which is backed by Fannie Mae and Freddie Mac, will have stricter guidelines on DTI ratios. FHA will only allow your total debt to be no more than 43% of your total income. For conventional loans, that limit drops to 36%. This means that all your debt, including personal credit cards, car payments, your current mortgage, and your future mortgage, cannot exceed these limits. Loans backed by Fannie and Freddie will fall into the qualified mortgage type of loans. Since they make up about 80% of all loans, they are abundant and cheaper in terms of fees and interest rates, which does lead to better terms for you, the borrower. However, if you don't qualify for QM financing, you can also look into non-QM loans, which would have looser requirements, but could have higher rates and higher fees. The second way you can run into trouble here is coming up with your own down payment for your next purchase. Depending on what type of loan you are getting, you are looking at anywhere from 3.5% to 5% of the purchase price for a down payment. If you have the money in your savings to cover your down payment and closing costs, you're looking great. If you don't, you may have another option. As previously covered, many accidental landlords have quite a bit of equity in their current home. You might be able to pull out some of that equity to use as a down payment. However, you should know that pulling that equity means adding more debt to your DTI ratio, and someone has to make that payment. Best case scenario, there is enough equity in the current house for you to use, and the rent will cover this added debt payment. Friends, I hope you found this video helpful. Becoming an accidental landlord could be an extremely lucrative way to get into real estate investing. With the right analysis, you can use your current home as a launching pad for this new venture. If you are one of those homeowners needing to move but feeling handcuffed to your current home, I would love to have a conversation with you to discuss your options. There are many benefits to real estate investing that become easier to attain for someone looking to rent their current home and buy a new one to live in. Thanks for watching, and catch you on the next one.